I've had a request from a student to go through another example of the impact of changing a credit policy, the terms of a credit policy. So I will do that. But is there anything else anybody would like to ask me in the meantime?
Ma'am, can you please go through the last question for inventory management for the tutorial?
Last inventory management question. Sure. Sorry, that was, who asked for that? Was it you, Zetu?
Yes.
Thank you. Sakshi, your hand's also up.
Yes, I do have a question. It's not necessarily related to this specific test, but I saw somebody mention on the group chat, I think it was Mandy, that there's an agri chat on the 24th. I just wanted to know, does the agri chat cover all the topics or specific topics?
Yeah, the agro covers the entire semester's work, so that will include next week's material as well. So it's all of topics 1 through 4. It'll be a quarter of each. And somebody else also in that regard asked in the chat, is it for everyone or people with a mark below 50? A corner, it's for, okay, it's primarily for anybody who's missed a test. Okay, so if you missed test 1 or 2, for whatever reason, it doesn't matter. This is why we have the agro in the first place. It's an opportunity for someone to get a second test mark. Having said that, we also have the discretion to open up that test to anybody who's failing the module and wants to better their worst test mark. So that is what we will use that discretion and make it open to those people. If you're not failing, I would suggest, look, it depends if we can get the sort of preliminary results out, because you're going to need to know, whether you're failing the module to know whether you should write the agro or not. So if we can't get those marks out soon enough, and you think that you're borderline or you're in danger of failing and you want an opportunity to improve one of your test marks, then we might well open it up to everybody. I've got another question. Which NPV calculation do we use? The financial calculator or the table? Or be specified? Neosha, I've never taught you using the tables. I've taught you using NPV on the calculator. If you are someone who, for whatever reason, is been using the table, yes, the answers will be slightly different because the tables round off all factors to 4 decimals. We would make an allowance for a small differentiation or just a rounding difference, as opposed to a difference where there's obviously been a mistake made. Will the test questions be similar to the TUT questions? Well, Justine, they can't be, because most of them are MCQs. But what can I say? The sort of concepts that are demonstrated in the TUTs, you're expected to know those to be able to tackle the questions in the test. Will it be sequential navigation? No, we don't normally make it sequential navigation. In other words, you can go back and forth as you see fit. All questions are MCQs? No, as I said in the outline, not all. I'm just saying that you've never had MCQs in your TUT, so that's going to be a different. There will be some wildcard calculation-based questions where you've got to calculate them and fill in the answer, that would be more like your TUT questions. Okay. So in addition to going through another receivables management example where the credit terms are changed or they're thinking about changing them, and the last inventory management question for the TUT, is there anything else at this stage anyone wants me to cover? Okay, I'm not seeing anything for now, but you might think of something as we're going through. Okay, I'm just going to stop my video because I know that it uses up bandwidth. And I'm going to share the screen and I'm going to find a question that I very, very quickly found. I just hope that it's going to, I haven't even had a chance to go through it. So I'm just hoping that it's a question that sort of resonates with the questions that we've already had. Just to note, I'm never going to give you a question that you have never seen before in terms of calculation-based questions, okay? Or that you wouldn't know how to answer. So you must use the methodology or the methods used in the slides, because that is the, that's the way we've taught you, and that is how we expect you to answer these questions. So we've got a retail supply of wetsuits, the company, blah, 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 blah. One of the issues they wanted to address is whether or not their credit policy should be changed. At present, the company's credit terms are 1/15, net 45, okay? I hope you know that means that they give their customers a 1% off the invoice, if you will, or the sale, the sales amount, if they pay them in 15 days. Otherwise, they have to pay 100% of the invoice amount or the sale amount in 45 days. All sales are presently and in the future will be on credit, okay? So no cash sales. 20% of the customers take advantage of this discount currently. So 20% of them pay within 15 days and get 1% off the sale price. That means that 80% of them don't, and they pay in full within 45 days. A major factor affecting profitability appears to be the fact that the company's bad debt losses amount to 10% of sales. That's 10% of the sales for which the discounts are not taken, obviously. Because if a customer takes the discount, obviously they're going to be paying you. But it's the 80% of the customers that don't take advantage of the discount, 10% of those become bad debts and are never recovered. So to rectify the situation, management are considering a more effective use of discounts to encourage early payment. So they're considering new credit terms of 2/10, net 30. So they're upping the incentive to pay early by saying you can get 2% off the sale price if you pay within a shorter period of 10 days, and then otherwise you have to pay in full in 30 days. So they're reducing both the discount, they're thinking about reducing both the discount period as well as the net credit period. And they're expecting that this policy will result in bad debts amounting to 2% of credit sales. And that'll apply to the 30% of the customers that aren't likely to use the new discount facilities. Management expects that the new credit policy is likely to increase annual sales marginally from 15 million to 17 million, so an additional 2 million. And they estimate that the gross profit margin will remain unchanged at 20%. So they make 20% on each rand of turnover. meaning that costs are 80% thereof. The opportunity cost is 10%. We're assuming 360 days in a year. Calculate whether the new policy should be implemented or not. Now, when you've got terms that involve a discount and a discount period, the first thing that you need to do is work out what the average collection period was and what it's going to be. So that is what we do first. This is just, I took the solution from the textbook and I hope it's correct. These are just it's a summary of the information. So currently they sell 15 million worth of sales. They're hoping to sell 2 million more. The gross profit margin will stay at 20% throughout. Opportunity cost of their money is 10%. The old credit terms were 115 net 45, and the proposed ones are 210 net 30. Bad debt losses old were 10% of non-discount sales, and of new will be 2%. They actually don't mention of non-discount sales. I would assume it's the same. Yeah, definitely. Unit sales old was 15,000. Unit sales new, 17,000. Did they tell us that? No, they didn't. I don't think we need that information anyway. Percentage of customers taking the old discount was 20%. The percentage of customers that'll hopefully take the new one is 70%. Okay, so as I said first, we've got to work out the average collection period under the old and the new policy. And you do that, so for the old policy, the discount sales, 20% of them are going to take 15 days to pay because they'll take the discount. And that should be, why is it 72? Oh, it's less the bad debts. Should be 80. Why are they taking off 8%? This is the problem of using a question and then not having had a chance to study it. Why did they take the non-discount sales? The bad debts for the old policy is stated as 10% of here we go. For the old policy is stated as 10% of non-discount sales, which is 10% of 80%, which is 8% of credit sales. Okay. And the bad debts for the new policy is stated as 2% of credit sales. We've excluded the bad debts from the collection period as we will never collect these debtors. Okay, I get what they're doing. Okay, don't worry. I'm never going to give you anything that's complicated, but I can see what they're doing. Okay, so read this in conjunction with what they've done here. So what they're saying is under the old policy, 20% of their customers take 15 days to pay, and 72%, which is the 80% minus the 8% that are never going to pay, because obviously if they're not going to pay, it's not going to take them any days, they take 45 days to pay. So under the existing or old policy, the average collection period is the sum of those two. It's 35.4 days. Under the new policy, 70% of their customers are going to take the discount and pay in 10 days. And again, instead of 30%, we're using 28% because the bad debts for the new policy was stated as 2% of sales. So we're not including the bad debt percentage in these figures because obviously they're never going to pay. So that is not going to affect your ACP. Well, that percentage of people mustn't be part of the calculation. So 28% of them will take 30 days to pay, those that don't take the discount. So they're hoping to bring down their average collection period from 35.4 days to 15.4 days, which is a reduction of 20 days. Okay, so they on average going to be collecting from their customers 20 days earlier than before under the new policy. Okay, so that's an initial calculation we have to do. If there's remember when we're trying to evaluate a policy switch, there's going to be a few considerations. Your gross profit is going to change, up or down, depending. Because you're changing your cash discount, there's a cost involved there, and you have to consider that. Your bad debt percentage is changing. You've got to consider whether that's going to be an in or an outflow. And then you've got your opportunity cost of your accounts receivable. The money that you have tied up in receivables, whether that's going to be a saving or a cost. And then you put everything together to get your net benefit. Okay. So starting with the change in gross profit, that's normally a pretty easy one. They're going to sell 2 million extra units, and the gross profit percentage is 20%. So the change in gross profit will be 400,000. The discount that they, remember, every time they offer a discount as part of their terms, it costs them money. So at the moment, 20% of their customers are paying 1% less than, or they're getting 1% off the sale price. So we go 1% of the 15 million sales times 20%. The cash discount in the old policy costs them 30,000. Under the new, it's going to cost a lot more because 70% of their customers are going to get 2% off what they purchase, off the purchase price. So that's going to be a big increase to 238,000. So the difference will be a negative 208,000. They'll have to spend 208,000 more than before on the cash discount that they're proposing to offer. So that's a negative.
Sorry to disturb you.
Yes. Yes.
Can you just repeat the change in cash discounts for the new policy again?
Okay. So what they told us was that they're considering changing their terms to 210 net 30. So what it says, and 70% of their customers they're anticipating will take that discount. So what it means is 70% of their customers are going to get 2% off the sale price. And that's going to cost them. Okay, because instead of getting 100% of their sales, which would be 17 million, they're going to get 2%, they're going to get only 98% of that. Okay, and 70% of their customers, so 70% of their sales are going to get that 2% reduction. So that's why it's going to cost them 238,000. 238,000 less than what they would have got. Does that make sense? Sorry, while I'm sharing my screen, I can't see who's talking or who's got their hands up or anything. So I don't know who asked the question.
Yes, thank you. Makes sense.
Is it okay? It's exactly the same as for the old policy, but only 20% of them are currently, their customers are currently taking the discount, which means they're getting 1% off the sales figure. Okay, so overall, that change in cash discount is going to cost them 208,000. Okay. Bad debts wise, under the existing policy, I'm trying to remember. Bad debt losses old, 10% of non-discount sales. Now, 20% of their customers take the discount, so 80% don't. So it's 10%, 10% of the 80% that don't take the discount that will go bad. So it's 10% of 80% of their whole sales figure is what they currently lose in terms of bad debts. Under the new policy, for some reason, I don't know why they didn't say that it's going to be 2% of the customers who don't take the discount, but they never specified it. So we have to assume that they're just saying 2% of their customers, 2% of their sales will go bad, which is 340,000. Now that's going to be an improvement in cash flow of 860,000. They were losing that amount. They're only going to lose this amount if they change the policy. So that's a positive 860,000. So it's 80% here because they specifically said that 10% of the sales made to customers who don't take the discount go bad. So that's why 80% of their customers who don't take the discount, it's 10% of them. Okay, whereas they never specified that about the new policy. They just said 2%. The policy will result in bad debts amounting to 2% of credit sales. They didn't specify that it's a percentage of sales for which discounts are not taken. Okay. Again, it's a little bit complicated. It would be very clearly specified for you what was meant. Okay, so far we've got a positive change in gross profit. We've got an additional expense in the cash discount and offering that increased cash discount. We've got a saving due to the change in bad debts. And now we've just got to work out what the opportunity cost of debtors is. So remember, they've got money. They're going to, at the moment, they've got a certain amount of money tied up in debtors, which has an opportunity cost because they're supposed to have got those sales, but they're giving their customer that sales revenue, but they're giving their customers time to pay. That money that's tied up in debtors has a cost to the firm because it could be used for something else, earning a return. And in this case, that return is, I think they gave it to us as 10%, that opportunity cost. So we've got to work out what this new policy is going to mean in terms of the additional or incremental investment in accounts receivable. So this is where that initial calculation came in, where we worked out that with the new policy, they were going to be carrying receivables for 20 days less than before, because the average collection period is going to be 20 days quicker. Okay, so 20 days is that reduction in ACP. So translated into the additional sales of 15 million. So these not only will they be able to collect their additional sales 20 days earlier, okay, and 20 over 360 times 15 million will mean a saving, a reduction in debtors for them of 833,000 on their existing sales, but they also have to spend, or they're also going to be incurring debtors on their new sales. Okay, so it's 2 million extra sales with a ACP of 15.4 days. In other words, on average, they're going to collect on an additional 2 million of sales in 15.4 days, 15.4 days in a year, so put it over 360. And remember, it's 80% of those sales, which is the cost of those sales. We minus the gross profit, because I'm just going a bit blank here. Sorry, I'm trying to explain the 80%. This is what they're going to have spent on those additional sales, and they're going to have to wait 15.4 days to be compensated for having sold, for having spent that money on those additional sales. That's what they're out of pocket. Okay, so as per the example in your notes, as per your example in the book, you work out your reduction in debtors based on the full amount of the sales, the existing sales, which you're going to have, in this case, you're going to be receiving 20 days earlier. But then also, you're going to have to work out what the cost of the additional sales, the incremental sales of 2 million, is going to cost the firm and be tied up for 15.4 days until they actually get the money back from having spent that money. So it's a two-pronged thing. You've got to add the two. It's what we did in the notes, and it's what the example in your book does, and it's how I changed the TUT question to in the revised version. So we've got a reduction in debtors on the one hand, because they're going to be collecting their existing sales 20 days earlier. That constitutes a reduction in debtors or an investment in receivables of that amount. But they're going to have to tie up the cost of producing an additional 2 million rands worth of sales for 15.4 days. And that translates into a cost of 68,444, or an additional investment in receivables of that amount. Add the two, and it works out as a net reduction, a net reduction in debtors, which is a good thing. Now, the saving on that is 10%. So it's a net saving of 76,489. All right, so we've got a positive change in gross profit. We've got an additional cost of the discount. We've got a positive change in bad debts, a reduction in the bad debts, which is a good thing. And we've got a saving in the cost of financing debtors. So all of those together will give us a positive 1.125 or 128 odd million. Because it's positive, it's going to be worthwhile to implement the new policy. Okay, so yeah, this question is a little bit more complicated than what you're used to, but the concept's the same. The process is the same, which is the same as what was in your TUTs, in your book, and in your notes. Okay. I will put this example up on Moodle as well for you to go through again. There's a lot of chats. Let me get to those before I go on to the inventory management. It's pertaining to this. Okay, Carrie-Anne, I assume you asked this question before. I actually found the answer to it in the solution. Wait. Are we gonna, I presume you mean going to, be given make-up test to improve for instance, if one didn't pass test one? I've already spoken about that. If the corrections to activity 3 will be made available, should we email Dr. Mkhadi? Please email him. Anything to do with topic 3, activity 3 is his indaba. That was answered. When calculating whether the company should consider, do we take into account the change in accounts receivable? Yes, that's what we did. That was one of the steps. You see what the change in investment has to be in accounts receivable, because that comes at a cost, an opportunity cost. Why do we minus the new credit policy for cash discount and bad debts? Well, we've got to work out the difference between the two. So what it was and what it's going to be. And it depends whether it's a reduction or an increase, whether we minus it all. Okay, I'll go back to it and I'll point that out. And where did they get the 15.4 days from? I'll go back to and point that out. Okay, so the first question was about why did we minus these two? Okay, because on the one hand, with the old policy, the discount costs them 30,000. With the new policy, it's going to cost them 238,000. So the change is the difference between the two. And it's not a good change. It's going to cost them 208,000 more. So that's why it's a minus. And here, under the old policy, bad debts cost them 1.2 million. Under the new policy, it's only going to cost them 340. So on a net basis, the change will be a good change of 860,000. They'll lose 860,000 less due to bad debts because this is less than that. It could well be the other way around, given a different scenario. You've just got to work out, whether the change is a good one. It's always going to be the difference between the two figures. And the change is either going to be a positive one or a negative one, and that will determine the sign. Okay. And the lady who asked where the 15.4 comes from, here it is. So it came from the terms which say that 70% of the customers are going to pay in 10 days and 28% of them are going to pay in 30 days. 2% are never going to pay, so they didn't come into the scenario. So it's 70% of times 10 plus 28% times 30 is the 15.4. So under the new terms, their average collection period is 15.4 days. And that's where that came from. Here we go. Okay. All right, I'm going to move on now to the other question that was asked. Here's another tunnel which understands. That's great. How many marks would a question like this appear for? Probably about 6, Aishwarya. 5 or 6. Maybe even more, maybe even 7. Okay. I'm now going to share the TUT with so it's TUT 4.2 with the inventory management. What's the inventory management TUT question? And Zetu, it was pertaining to the second one you said, am I right? Can you confirm that? Did you say yes? Okay. All right, so we've got a company that uses 800 units of a product every year on a continuous basis. So on what they're saying is it's on a steady basis. It's there are no seasonal spikes in sales. It's just 800 across the year. The product has a fixed cost per order of 50. Its carrying cost is 2 Rand per unit per year. It takes 5 days to receive a shipment after an order is placed, and the firm wishes to hold 10 days usage in inventory as a safety stock. So at all times, this particular firm wants to always have at least, at the bare minimum, 10 days worth of stock as a safety or sort of a buffer level of stock, so that in a crisis situation, they're never going to run out. Assume a 365-day year. Calculate the EOQ. Determine the average level of inventory and determine the reorder point. I'm not too sure which part of this you had a problem with, but let's go through all of it. So calculating the EOQ, remember the formula. It says that the EOQ, the optimal order quantity, can be calculated by finding the square root of 2 times the sales units per year, so it'll be 800, times the fixed cost per order, which is 50, divided by the carrying cost or the holding cost. Another word for that is a holding cost. That is 2 Rand per unit. Okay, so let's see the solution. There's the EOQ, square root of 2 times S times O over C, so it's 2 times 800 times 50 over 2, square root it, 200 units. So this firm should be ordering 200 units every time they do that. Okay. So the next question asked, what is the average level of inventory? Now, remember that sawtooth pattern. I wonder if I can draw on this. You know me, I'm terrible at drawing. I'm going to try and remember with this EOQ, it assumes that you order a certain amount here. It gets used up over steady time, a steady amount over time. Then the next order comes in and so on. So if every time they order, they're ordering, what did we say, 200 units. Over time, would you agree? So this is time, and this is number of units here. If every time they order, they get 200 units in, and then it drops down gradually to 0 and then up to 200 again, would you agree that your average level of inventory is always going to be what? Somebody? If it fluctuates between 200 and 0 over time, on average, then it'll be, you always take the order quantity 100. And divide by 2. Did somebody say 100? Sorry, I can't hear or see. So that's what that's what I'm doing there. Seems that I have to remove this first before I can move down. So we'll just clear that drawing. And then we can go down here. So there we have it. Average level of inventory is 200. Oh, here's me falling into my own trap. So on the one hand, it's 200 units. Over 2. That's on average. So that's based on the EOQ. But we can't forget that in the question it said they always want to have 10 days worth of inventory as a safety stock. So I wish I could draw my thing again, because what that sawtooth pattern actually sits on it sits on top of, sorry, that should go down to there, the safety level of 10 days worth of stock. Now, what is 10 days worth of stock? If they use 800 in a year, we'll divide by 365 days, and you get their daily usage, okay? And then you multiply that by 10 to get 10 days worth of stock. And that figure is what they have in stock here. Can someone look at that? What is that amount on the next page? Someone just shout it out to me. What was 800? What was 10 days worth of stock? Somebody?
21.92.
Sorry, 20?
21.92.
Units. Okay, 20, let's call it 22 odd. Okay. So what that sentence tells us, they always want to have 10 days usage in inventory safety stock, always, and they're not going to touch that. So every time they come down to 22 units, they're going to order another 200. So this up here is actually 222. Okay. So not only, and 0 is somewhere down here because this is their safety or buffer level of stock. Over and above their 22 units that almost always must be in stock, there's also going to be an average amount of stock as a result of this. And as we said before, that average is 200 divided by 2, which is 100. Okay, so not only will they always have 22 units in stock on average, but they'll also have half of the amount that they order and use up over time. Okay, so clear all drawings, and I'm going to go down here. And that's what we did. I was ignoring that, the safety level of stock. So here we worked out the usage of stock or units, the amount of units they use every day, and 10 days worth of units worked out to be, it was 22 units. And that plus the average of 100 between what they order each time of 200 units, drop down to 22, go up again, etc. That average was 100. So 100 plus 22 will be 122, the average level of inventory. And then what is the reorder point? So at what point should they pick up the phone and order? Now, remember, they're going to pick up the phone and order 200 units because we worked out the EOQ. Going back to the question, what was the delivery delay? It takes 5 days to receive a shipment after an order is placed. Okay, so they pick up the phone, they order their 200 units, but it only arrives 5 days later. So would you agree that when they pick up the phone, they must make sure that they not only have 5 days worth of stock left to keep them going till the order arrives, but on top of that, they're also going to have that 22 units that they're always going to hold in terms of 10 days usage as their safety stock. Okay, so the reorder point in days will be, in units, will be, this is the same calculation as before. That's the 22 units that they will always have in their safety stock. But they also have to have 5 days worth of stock to account for that delivery delay. So again, it's the daily usage times 5 plus the daily usage times 10. Or you could have said just 800 over 365 times 15, because they need to have 15 days worth of stock left when they pick up the phone. So they pick up the phone, they order their 200 units, knowing full well that they've got 5 days worth of stock on hand, so that by the time the delivery arrives, 5 days later, they will have used up the 5 days worth of units, but they won't have touched the 10 days worth of units either, which is the 22. So 22 plus, must have been 10.88. 10.88 units to cover them for 5 days. That's the delivery delay, and the 22 units to cover them for their buffer stock. If there had been no buffer stock, then the order point would have just been 800 over 365 times 5. They would just have needed 5 days of stock on hand to cater for the delivery delay. So if I go back to my drawing again, I keep drawing this thing. I wish I shouldn't have. I don't know how to keep it. Okay, so this is the 22. That's this buffer stock area. Remember, this is time. This is units. Okay, so every time they order 200 that comes in, because they always keep this constant. That means going up to 222, coming down to 22, then another order comes in, etc. But there's a 5-day delay. So they've got to not only have 22 units in stock when they pick up the phone, but they also have to have another 5 days of stock left, which would be this amount here. And that's where the reorder point in days would be, I think it worked out to be 22 plus 10, or was 32.88 was this level. So that would be the reorder point at each point. When their level has got down to that point, they'll pick up the phone and order, knowing that they've got 5 days worth of units still in stock to get them through till when the next order arrives, and they don't have to dig into their 22 unit safety stock.
So ma'am, the 22 units is like separate from the 200 units that they have to order.
Indeed, it is.
Okay.
Is that okay, Zetu?
Yes, thank you.
Let me see the questions. Can we go back to number 1 after we finish number 2? Sure, we can. Do we always round up or down? Okay, so to be conservative with inventory, you should always round up. So if you're working out how much to order, round up, because you don't want to round down, because that's going to imply you might be a bit short. So always round up with your inventory. For example, if it's 22.4, you make it 23. No, it won't be 24, it'll be 23. So whether it's 22.1 even, or 22.9, you'll round that up to the next whole unit. Okay. Can we please go over the change in investment of accounts receivable part in question 6 of tab 4.1? Yes, I can do that. When should we round off? I think I've just covered that, Carrie Ann. Somebody just said hello. When we're giving the final answer, should we round off to the nearest whole unit? Yes. Round up. Can you please explain how you got 2,000 in the previous question? 2,000. Ria, I do not know. Which question are you talking about? Don't think there was a 2,000 in this question. Are we talking about the previous example that I was working with? Let me see if there was a 2,000 there. Do you perhaps mean 2 million? I don't recall if if it's 2 million, it's the difference between the existing and the new sales. Difference between 70 and 15. Sorry, Ria, I don't know. Question 1 for this tutorial, the solution had 2,000. Oh, you want to go through question 1? Okay. All right, that was requested by a few of you. I know I'm going over time now, but I'm fine to keep going. Okay, so the first question here, they buy salt in bulk, repackage it into beer. They use 2,000 tons of salt per annum. I'm assuming that's the 2,000 you were asking about. It was given. There are 240 working days in the year, and the purchase price of salt to the company is 220 per ton. The cost of placing each order is 600 Rand, and the carrying cost is 100 Rand a ton. It takes a supply of 4 days, so there's a delivery delay of 4 days, and use the EOQ method to decide what quantity they should order each time they do order, and determine the total cost if they do order at the EOQ, and the reorder point, and the value of the average inventory in store. Okay, so that's a few questions in one there. So EOQ, simple. Just double checking there. Okay, so it's the square root of 2 times F times S. It's twice the fixed cost per order and the sales units for the year over the holding or carrying cost per unit per annum. So we get 154.92 tons. We'll round that up to 155. The next question was total costs. Determine the total cost per year if they do order at the EOQ. Okay, well, if they order at the EOQ, they're going to be ordering in a year. Okay, if they use 2,000, if they need 2,000 units for the year, and every time they order, they're going to order 155 tons, they're going to be ordering about 13 times. We need to work out the number of orders to work out the total ordering costs. We also need average inventory to work out our total carrying or holding costs. So we put EOQ over 2 to get average inventory at 77.5 tons. Now, I'd leave that at a half a ton because you can order a half a ton. It's not like items where you can't order a half an item. You know, you'd have to round that up. But in this case, we can leave it at 77.5 tons as the average. Now, the total costs per annum, remember, are your total ordering costs plus your total carrying costs. And the ordering costs, if you order 13 times and each time you order, it costs you 600, that'll be your total ordering costs. Your total holding or carrying costs will be your average inventory of 77.5 tons times your carrying cost per unit per annum. Okay, and remember, if you order at the EOQ, your ordering costs and your total carrying costs should be equal, or more or less equal. Obviously, there's been a bit of rounding involved, so they're not quite equal, but close enough, because that's where your total cost will be at a minimum. Again, I'm going to draw you a little diagram to reiterate that part of it. Here, what diagram am I? Oh, yeah, I'm doing my costs. Remember, there's certain costs that increase as your order quantity increases, and those are your carrying costs or your holding costs. There are other costs, though, that decrease as you increase your ordering quantity. So this is order quantity here, and this is costs in rands. And the total of these two costs, so this is, I'm going to call these your carrying costs or your holding costs, and these are your shortage costs. Carrying costs increase as your quantity order quantity increases, shortage costs will obviously decrease as you hold more shortage or ordering costs. Same thing. Okay. They decrease as you hold more inventory. And your total cost curve, which you would plot based on, say, it's your, for any given quantity, it's your carrying costs plus your shortage costs. Okay, and that's how that cost curve is drawn. Those total costs will be at a minimum where your carrying costs and your order costs or your shortage costs are exactly equal. And that will correspond with your optimal order quantity. Okay, that was the theory behind this EOQ model. Okay, so here we have been working out, we worked out at the EOQ, we worked out the carrying costs and we worked out the shortage costs or the order costs, and they were pretty much equal, which is what they should be, because we know that that's where your total costs will be at a minimum. Okay. Let me clear that so that I can scroll up. Okay, so that's sort of a check that your EOQ is correct. You know, these costs need to be pretty much equal. And these are the total costs, the sum of your ordering costs and your carrying costs, or your shortage costs and your holding costs. Same thing. Now, what was the next question? What is the reorder point? And then what is the value of the average inventory in store? Okay, the reorder point, like we did it before, we've got to work out what the average daily usage is. And that we take by dividing the total usage for the year of 2,000 tons, divide by the number of days. This is the working year for them. It was given as 240 days. If it was given as 360 or 365, or it wasn't mentioned at all, then you'd assume a 300, well, it would always be mentioned whether you must use 365, 360, or in this case, 240. So they use 8.33 tons a day. So because there's a delivery delay of 4 days, they need to have 4 days worth of stock on hand when they reorder. And that will amount to 33.33 tons, which will round up to 34 to be conservative. So when they've got 34 units left and tons left in stock, that is their reorder point. That is when they'll pick up the phone, order, such that in 4 days' time, their EOQ will arrive and they can they'll have restocked. Value of average inventory in store. Well, we're just going to use the average inventory that we calculated earlier of 77.5 tons times the variable cost, which was given to us. The purchase price of salt to the company is 220 Rand a ton. So we multiply that by the average inventory to get the value of the inventory in store. All good? Let's see if there are any questions about that. Where did we get 2,000? I hope you know that now. Tando. Could we also use the total cost of inventory formula? Yes, there's a formula in your textbook, but note that is the formula specifically for the total cost at the EOQ. So if the firm's ordering at the EOQ, you can use that formula because it's related to the EOQ formula itself. But I rather teach you this method because you're not always, you might get a scenario where they're ordering, say, 200 tons. And you get asked a question, what are the costs? What is that costing them per annum? So then you'll work it out using the total ordering costs and the total carrying costs. based on the 200 tons that you're ordering currently. And in that way, you can see whether it's optimal or not. Because if the total ordering costs are a lot higher than the total carrying costs and not equal, which is what they should be if they were ordering the right amount, then you know that they're either ordering too much or too little. Too much if this total carrying cost is too high, or too little if the ordering costs are too, you're ordering too little if your ordering costs are too small. Okay, so rather understand this and that graph that I drew, because that formula, as I said, will only work if you are actually, if the firm is actually ordering at the EOQ. And that won't always be the case. You might get a question where they're not ordering at the EOQ, and the question will ask, is that optimal? And then you can prove whether it's optimal or not by looking at the total ordering costs and the total carrying costs. If they're not more or less equal, then the order quantity is not optimal and they're not minimizing their costs. Okay. Where are we time-wise? 124 crumbs. We've gone quite a bit over. I'm trying to remember the other question. I think it was question 6 of the TUT. The receivables management question. So it's TUT 4.1. It was question 6. No, these are the solutions, not the questions. But we can probably work that out. So the additional profit contribution from sales, they were going to be selling 2,000 additional units under the new policy at a contribution per unit of sale price minus variable cost. So the profit contribution was going to be 18,000. Let's look at the more simple things before we get, so there was no mention made of bad debts in this example, so you didn't have to worry about it. But there was going to be a cost of the cash discount. They didn't have one before. I remember this question, but they were now going to have a cash discount of 2% off the purchase price. And the sales were 45 times 42,000 units. The sales revenue was 45 times 42,000 units. So 2% of that was going to be the cost, taken up by 70% of their customers. So it was only going to apply to 70% of their sales that they would have to give away 2% off the purchase price. So the cost of the discount was 26,460. Then there's the cost of incremental investment and accounts receivable. So under the present plan, they're going to be able to collect on their sales 30 days earlier. So those are their current sales, 40,000 units at 45 Rand. And they're going to be able to collect on their sales 30 days quicker, sooner. So that is going to be a reduced investment of 147,945. In addition to that, the incremental investment when it comes to the proposed plan, they're going to be producing an additional 2,000 units from before at a cost of the variable cost of 36. And they're going to have to wait 30 days before they receive or get that money back. So it's times 30 over 365 is the incremental investment, the additional cost or the additional investment in accounts receivable that the proposed plan will bring about. So those two added together means a reduced investment in accounts receivable overall. So that's a good thing. 142,027 less money tied up in receivables at an opportunity cost of 25% means a saving of 35,507. and then you just put those three together. The net effect will be a positive 27,047, so the project should be accepted. We'll just go back to the question. That's what I should have gone through first. Okay, they currently, all their sales are on credit and they don't offer a cash discount. They're thinking of offering 2% of a discount for people who pay within 15 days. Their current ACP, so it's already been calculated for you, is 60 days. They sell 40,000 units at 45 Rand per unit and a cost of 36. If they introduce this discount, the sales will go up by 2,000 units. 70% of the customers will take that discount and get 2% off, and the ACP will fall to 30 days. So it's going to go from 60 days to 30 days, which is why the first part of that calculation showed that they're going to be collecting on their existing sales 30 days quicker. 25%, no mention of bad debts, so that's why that didn't come into the equation. So sorry we did that backwards, but hopefully that now gives you a bit more clarity. So here's the 30 days earlier that they'll be collecting their existing sales. So that's a good thing. It's a saving, a reduced investment in accounts receivable. Here's the cost or the additional investment in accounts receivable on having to produce the additional 2,000 units and having to wait 30 days, which was the proposed plan ACP, to get that money back. Okay. I think that's probably a good place to stop. Are there any final questions from anybody? I think I've been through the whole chat. Yeah, when it comes to topic 4, a lot of it is common sense, actually. The theory part of it, certainly. Just know your way around that working capital cycle and the cash to cash cycle, because that's key when managing working capital management. The objective, remember, is to make that working capital cycle, and hence the cash conversions, the cash to cash cycle, as short as possible. Because that'll involve less money tied up in working capital. Know what you can about aggressive and conservative financing policies. And then there's receivables management and inventory management. Topic 3 and 4 questions going to be divided in the test? Yes, they will be. I don't like to confuse you unnecessarily. Is it 20 or 30 questions? Who knows? We're still getting there. We haven't finished setting it. As I said, it'll be 20 to 30. Whatever it is, it'll be carefully worked out such that we think you've got, a reasonable amount of time to answer those questions in the 90 minutes. All right, guys, good luck with your studying. I think I'm going to move. I've become aware that you've had to, I think they've moved an ECOS test. No, they haven't moved your ECOS test, but you've got an accounting test on Monday. And I think some of you have got stats as well. So that might mess up your weekend. I was thinking you've got the weekend and Monday to do the activity 4. I might extend that into next week rather. I don't know when your other tests are, but would it suit you to say have Tuesday and Wednesday to do the to do the activity? But Tandwa likes that. Anybody else? Yes? Okay. Yes, I'm seeing quite a few yeses. Okay, so what topics will the activity cover? I've told you it's going to be a cash budgeting exercise. That is why I posted that stuff earlier for you than next week, so that you can actually so that you can actually work on it on the weekend. But as it turns out, you'll only be doing it next week anyway. So you've got more time to prepare. What topics will the activity cover? Yes, I've told you that. Okay. So I'm probably going to open the activity on Monday evening, and you can go till Wednesday evening with it. Okay. There and thereabouts. But I'll put a notice up, obviously. Okay, thank you all so much for being here, and I hope it's been of benefit, and I will pop the recording up on Moodle. Okay, take care and good luck for the test. See you then. Bye.